The Bureau of Labor Statistics revised the nation's job growth lower by 911,000 for the 12 months ending March of this year. That's a much deeper than expectations of 682,000, and this was expected by analysts before the report. And for a look now at what this means in the broader economic context, I am joined by Gus Faucher. He is a PNC Financial Services Group chief economist. So we're talking about something that's kind of wonky here. It moved the market a little bit, but we're talking about revisions to a BLS data set that affect things that is kind of rearward facing here, going all the way back to March. But this is very important because data integrity is front and central in people's minds here. Just lay out what is happening here today and maybe give us a little bit of context.
Sure. So the Bureau of Labor Statistics, the monthly employment data is based on surveys of employers that the BLS sends out, but then they adjust that for unemployment insurance data, which is much more complete, which covers the entire universe of employers. So every year, the Bureau of Labor Statistics goes back, they look at unemployment insurance data, and they use that to benchmark the employment data. And what this data shows is that employment in March of 2025 was lower by about 900,000 compared to what the BLS had previously estimated. That means job growth from the period of March of 2024 to March of 2025, was significantly lower, slower than we thought, and the labor market isn't quite as strong as we thought it was before these revisions.
So two questions here. How much does this impact the thinking at the Fed, which is meeting next week and has to decide on interest rate policy? And then what would you say to address some of the headlines and stories that are inevitably going to come out of this, that labor market was actually much weaker than we expected, and there might be some conspiracy theories thrown in there? How do you account for this, and how do you think about this?
So the first thing in terms of the Fed, first of all, these revisions are only valid as of March of this year. So they don't necessarily tell us anything about the job market in August and September. But what they do indicate is that, in the second half of 2024 and early 2025, job growth wasn't as strong as we thought, certainly not as strong as the Fed thought. And so that suggests that interest rates perhaps are too high and that the Fed may need to cut interest rates in the near term in order to support the labor market. In terms of the integrity of the data, this is a data integrity effort. The BLS is incorporating as completed data as they can get to make sure that the numbers are more accurate. If we were to try to include these unemployment insurance numbers every month, that would delay the data tremendously, and that would make it much less useful for the Fed. It's very important for the Fed, for economists, for business people to have access to timely monthly employment data, and then when we can, to go back and do these revisions based on the more complete unemployment insurance data. I think the overall story hasn't really changed that much, which is we had a very strong labor market in 2023. We had slower job growth in 2024, and then we've seen an even more significant slowing in job growth this year, suggesting that the economy is just adding 20,000, 30,000, 40,000 jobs per month in recent months, and that's much slower than what we've seen over the past couple of years.
And I want to build on what you were just talking about. Since the pandemic, the government the BLS in particular, sends out these surveys to households and businesses, but response rates cratered, and then they haven't rebounded to where they were before the pandemic. So how reliable are the current figures that we're getting in? And does it warrant any kind of discussion about how we could improve those numbers?
There's no question that revisions recently, and particularly in recent months, have been larger than what we have seen historically. We had enormous revisions coming out of the pandemic, then things settled down, they picked up again in 2025. And certainly that makes it more difficult for the Fed. It makes it more difficult for me and other economists to try to forecast when we see big upward or downward revisions to job growth of 50,000 per month, 75,000 per month. We can invest in the Bureau of Labor Statistics so that they can come up with more accurate ways to get data from employers. We can come up with ways to get employers to respond more quickly to the data. This is perhaps the most important data that we get on the state of the economy. Again, it's very timely. We get it in the first week of the month for the preceding month, so it's a very good indication, and the Fed depends enormously on it. So we should be thinking about ways to fund the Bureau of Labor Statistics so that they can improve response rates, perhaps incorporate this unemployment insurance data more quickly. And so we need to think about ways to make sure that they are fully funded and staffed.
We had about 30 seconds. Any expectations for CPI ahead of this big Fed meeting that we have next week?
I expect to see a 0.3% increase in both core and overall CPI for August. Inflation is starting to pick up as businesses pass higher tariff costs along to their customers, and that's going to be the story throughout the rest of 2025.